Dustin, good to see you. We're going to start with an important question. Are you tax ready for retirement? Taxes, of course, don't disappear in retirement as much as we would want them to. In fact, understanding tax implications becomes even more important. So let's talk through 4 tax questions that you should ask your advisor before retiring. Question number 1, how will my tax situation change once I retire?
Sure, we can talk about a big assumption. So we've all been told that when we retire, we're going to retire to a lower tax bracket.
Yeah.
Some quick history. So the 401k began in 1978. At the time, the top marginal tax rate was 70%. It's about half of that now. So if, for example, you were a highly compensated executive back in the 70s and 80s, and someone told you you should defer your taxable income because you're going to retire in a lower tax bracket, there was probably a lot of truth to that. It doesn't necessarily mean it's true today, and it certainly doesn't mean it's true for everyone. And also keep in mind, hey, if you are going into retirement and you're planning on trying to maintain your lifestyle, it's going to generally mean maintaining the same kind of spending. So if we're maintaining the same kind of spending, and now we're taking that money out of, let's say, tax deferred accounts that are 100% taxable, just like your paycheck was, it's probably going to mean a similar tax bracket.
Mhm. Next question, are there strategies to reduce my tax liability in retirement?
Sure, a few things we could talk about. You want to maximize your Social Security benefits. So you want to pay close attention, get some good advice on claiming strategies, when to claim those benefits. It's important to remember, depending upon how your assets are structured, anywhere from 0 to 85% of your Social Security benefits will be subject to taxes. But 100% of the withdrawals you make out of your 401k, for example, are going to be subject to income taxes. So generally speaking, the more Social Security income that you can build into the plan by optimizing those benefits, the more tax efficient you're going to be. You also want to pay attention to non-qualified accounts. Those are those taxable accounts outside of retirement accounts, things like CDs, money markets, regular brokerage accounts. You want to look at things like swapping investments or savings that pay interest for investments that pay capital gains. And in particular, you want to look at, and the reason for that is, the taxes, ordinary income taxes you pay on interest isn't nearly as friendly as capital gains rates are.
Right.
And in particular, you want to look for investments that don't realize or pass through that gain to the investor until you as the investor make the decision to sell, things like most ETFs. You want to make sure you put the right investments in the right accounts. So things like actively traded mutual funds that may have a lot of turnover, not necessarily anything wrong with that. That's a fund that you want to hold inside your IRA or your retirement account, not in a taxable account. The same is true for things like bonds that generate interest subject to income taxes every year. Put those in your IRAs, your 401ks, not in the taxable accounts.
Mm-hmm.
And it's a perfect time to consider Roth conversions. May not be right for you, but you certainly want to think about it, not only because tax rates are historically low right now, but also because doing those conversions may put you in a situation where the Social Security you're going to receive throughout retirement, where less of that may be subject to income taxes.
Mm-hmm. Yeah, just being able to tap, those separate tax triangles gives you a lot of autonomy when it comes to your tax situation. So on the Roth conversion note, I wanted to ask, because I think a lot of people have wondered before, should I consider a Roth conversion before I stop working?
Well, you certainly don't want to reflexively wait to consider conversions until you retire. Okay. I would think the thing you really want to pay attention to is, can I do a conversion in any given year at an attractive tax rate? And one of the other big things you want to pay attention to is, can I pay the taxes from an outside source or an outside account? You never, generally speaking, you very seldom want to do a Roth conversion where you pay the taxes from the 401k or from the IRA. Doing that eliminates all the benefit from the conversion in most cases.
Mm. And then the last question comes down to your withdrawal strategy. What are the tax implications of withdrawing from my various accounts?
I'll give you one big thing to think about here. On a tax deferred account, $1 worth of growth on a tax deferred account, once you withdraw it, it's going to be worth 70, 80, or 90 cents to you when you pay the taxes. A dollar's worth of growth, however, on a Roth account, when you withdraw it, is going to be worth 100 cents to you. When your beneficiaries inherit it, it's going to be worth 100 cents to them. That alone can present a lot of planning opportunities.
I'm really glad we got to talk this through. I know these are questions that you talk through with clients all the time who are trying to determine if they are ready for retirement. So if somebody would like to walk through this with you, Dustin, what's the best way to reach you?
Give us a call or a text at 830-476-2505, or reach out on the website to book a free chat at longlivemymoney.com.
Dustin, thank you.
Thanks, Aaron.